Okay, I think, can everybody hear and see me loud and clear? Looks good from my end. Okay, well, thanks again. I thank you so much for having me here. These are great summit here for the speakers, and some great trading education is going to take place here today. So what I'm going to be talking about is, how to trade these kind of extreme market situations that we're in. So we're constantly having some kind of uncertainty in the market, but now there's quite a bit more extreme market conditions that we have to deal with. So two of the best trading strategies or spreads I've found for trading kind of extreme market conditions is to go to what I call the butterfly and the long condors. So today's presentation is purely for educational purposes. Any stocks, options, futures, or ETFs mentioned does not constitute advice and should not be construed as a recommendation. So when I'm looking at trading, the thing that really stands out as far as, when I break down a trade, what makes it a successful trade, it really comes down to kind of three things. So direction, you get the direction right on your trade, you get the timing, the entries, the exits good. But then the big other third component is options to manage your risk and what I call opportunistic risk management. And so within these two types of strategies are perfect for this kind of environment. Now, I've been trading options now for over 30 years, and I've found that the most valuable go-to option strategies that can really help literally any trader or investors, more so during times of extreme market uncertainty, are the option butterfly and the long condor. So it's kind of what I call my trading secret weapon. Now, the huge advantage that these strategies give you is their unique option framework that's designed to take advantage of both time decay and volatility, which are the two main option pricing components. So this will help stack the trading odds in your favor, and then you can be used for any type of market environment, but really great when we get in really high uncertainty type markets because of the low capital at risk. So it just comes down to then knowing when and how to use them and the different variations that you can use between a butterfly. Now, because they're structured for only a small amount of your hard-earned capital, your trading returns can be very explosive, and it's kind of what I call lightning in the bottle. So if you ever had a really great trade that took off and was perfect, you're saying to yourself, man, I wish I could, bottle that one. And so kind of a trading term here that we used to use a lot, trading oil, kind of like lightning in a bottle. And that's how they can be. Now, the butterfly and long condors are very dynamic, and they can be traded for a variety of different reasons with different goals in mind. So in other words, you can learn how to trade the butterflies and long condors, and you're going to be covered for both your offense and your defense. So goals and protection. So it really gives you some really great advantages, to profit and also for protection for hedging. Now, these two strategies can work no matter what the markets are doing. They can be up, down, or sideways. They're going to really help to provide income for stocks that are going nowhere, eliminates the stress of having to be perfect on a stock's direction or overall market, eliminates the time decay expense that you encounter from decaying long options, which is a real, booger, when you're trying to trade and you keep losing your premium based on decay. So this is what's great about the butterfly condor as well. Now, they can be structured for very low cost, low capital at risk, and offer returns of 10 to 1 or higher. So of all the different options, strategies, or spreads, the butterfly actually will give you the highest return on risk of any of the other options spread strategies. Now, when we look at the butterflies and long condors, that are also great for hedging. So when you mess it up, and that's going to happen, you can quickly cover your, position with a really fast move by converting to a butterfly or condor. And I've found no other hedging strategy that comes close to this kind of way to defend a trade. So basically, by constructing either a butterfly or a long condor around a strike that is under pressure from another core trade that you have set up, such as if you do credit spreads or maybe a debit spread, and they start to go against you, you can hedge those quickly by adjusting to either the butterfly or a long condor. So it becomes a great way to immediately not only neutralize your risk, but lower the risk of your trade, lower the capital that you have at risk. Now, one of my members, Pam, she said, wish I'd known how to do this hedging before I lost so much money doing credit spreads. And that's so true. If you are out there doing credit spreads, you know the feeling when it goes to your short strike and then you maybe had a potential reward of maybe 25-30%, but it goes through it and you lose 2 to 3 times your amount of credit that you were trying to receive. So it can pretty wipe you out pretty fast. So it's a great way, once you understand the butterfly, we can hedge a credit spread easily, and I'll talk about that a little bit later. Now, the basic concept is, when we look at the butterfly, here's an example of let's say a call. We can do calls or puts for butterflies or condors, but here's, let's say you're long a call here, short a call here, okay? So the total cost or risk on this trade, this would be like a call debit spread, would be $300. Now you can see your spread width here is 1,010 is your long call, and then 1,020 on your short call. So it's a $10 wide spread, $10 wide times 100, so that's $1,000 wide spread. All right, so your risk is 300, and your total profit might be 700 is the difference. So if we wanted to reduce that risk, we could do a butterfly. We can convert it to a butterfly by simply selling a bear call credit spread, sharing that same short strike of the call debit spread. So in this example, we could sell the 1020 short strike here, call, by the 1030, $10 wide spread. We bring in $200 credit. Now we've got a potential to make only 200, but our risk is the difference of 800. So that's the difference between credit spreads and debit spreads. But when we put the two together, we've created a simple butterfly. So now we've reduced our risk that was originally $300. Now we've dropped that risk down to $100 per butterfly spread. And if it was to go out right at expiration at the top of the tent right here, we call this the profit tent, theoretical profit would be $900, which on your return of, or on your risk of 100, that's a 900% return. So you've got this profit zone in here that's, gives you the potential to make really nice profits, but on very low capital at risk. And that's what gives you the really high risk reward or reward to risk kind of positive ratio that we get from this type of trade setup, which is phenomenal. And I'll go through some examples to show. Now, the long condor is another one that's super great. Not too many people seem to know about or use it, but it's one of my favorites because it's similar to the butterfly, but what it does, you can see, we can spread that profit zone out. We don't have to have that perfect, thread the needle perfectly. So we can spread that zone out here and have either do with calls or puts. And now we have a long condor, which is very similar to the butterfly, but just a wider profit zone. So it's a great way to, set up a trade for low risk, but have big return potential on that trade. Now, the core concept that make the butterfly and long condor dynamic really comes down to the option Greeks. And the most important option factor, for these two strategies, the butterfly and condor, comes down to understanding, again, how option pricing works, and then the concept of time decay or theta and its effect on your price of your option. So let's take a look at this kind of core concept. Now, we look at the option theta concept, or theta, what it does. Theta tells us, is the Greek that tells us how much an option price is going to go down over time. And so that's the rate of the time decay. So the theta is the Greek that measures this time decay of your stock option or whatever options you're trading. So it's one that you really need to take advantage of and work with, especially when we do butterflies and condors. We can really take advantage of theta decay. Now, here's an example of a butterfly spread construction, just the simplicity of it. So walk you through the math. So here's like the company XYZ, and it's trading at $45. So in this example, just looking for a move to 43. So think the market's going to go down. We're not looking for a big move. So we can structure butterflies for small moves, big moves, whatever, in very short duration if we want. So in this example, we're targeting $43. So move down of $2, right? Now, typically what I like to do is when I'm, have a target price. So that's where we're going to set the body of the butterfly typically. So in this example, we'd be going long the a put, the September 44 put at 238, so $238 on that debit cost. Then we're going to sell the 43 put, September 43, twice, and we're getting $1.67 2 times to bring in that premium. then we're going to buy the 42 put to cap our risk to the downside on that short put there. So you can see the difference then between the spread width is 44, 43, 43, 42. That's $10 or $100. So the total risk on this trade would be the debit cost of $238 plus $1.06 less the credit you bring in from selling that 43 put twice times 100 to make it into a spread, and your risk on this spread then is your debit pay of $10. So that's your max risk there going in. Now your profit is you just take, like, say for example, the middle strike 43 minus your 42, so $10 wide, minus your cost of the trade 10 cents. So that gives you a potential to make 90 cents or $90 per butterfly spread, which on your risk of 10, that would be a 900% return, or you're risking $1 to make 9. So again, if you look back and look at your trades, you're probably not going to ever see a trade where you get a better return on your capital at risk than using a butterfly spread, or we'll go into long condor as well. So that's the beauty of it. Now, the next thing is, how do you choose the best butterfly or long condor strategy? And it really comes down to, in my opinion, your trading goals. So as a trader, everybody here, you're going to have a different capital account. So, Alice might have, be trading $100,000 capital account, trading account, and Chuck might have 10,000. So it's a big difference. So that's going to make an impact on how you trade and your risk profile of how aggressive you want to be. But with the butterfly condors, we can do these two strategies on any size account. So you could do a one lot trade that might cost you, as little as $10 literally, or you might do thousands of contracts. So, I used to do a lot of oil options and stuff, and we used to do butterflies. You could do, thousands of contracts on those, or as a retail trader like ourselves, we could do one contract or 10 contracts. So it's a very, very great strategy for small accounts or big accounts. So then when we look at it, you want to select your trades that are going to, again, provide you, in my opinion, with really kind of consistent positive returns. And I always look at the risk first. So I want to look for low defined risk, and especially when we're in market conditions that are extremely uncertain right now, we want to keep that risk super premium low, right? So I do that looking at risk first versus looking at the potential biggest return on a trade structure. Now, by doing this, you go through the different option strategies, and you're gonna see that the butterfly and long condor really can provide just this, that low defined risk, where you still have potential to make a big return on that lowered risk. So let's go through what I call the butterfly family. So this is all the different variations you have with butterflies. We could do a long call butterfly, or we could use put butterfly. We could do what we call it broken wing call or put butterfly. Sometimes this is referred to as skip strike butterfly. We could do a ninja or unbalanced ratio butterfly. We could do an iron butterfly, and then we've got a whole nother category here of hedging. So this alone is worth the structure and understanding how to use the butterfly to hedge another core trade position by doing this strategy. And then we've got what I call kind of the cousin of the butterfly, which is the long condor, which we can also do then with calls or puts. We can do broken wings. We can do a lot of variations also with the long condor, like we just would do with the butterfly. So it gives you a really complement of great trade strategies to use. So let's go through a bunch of different ones to show you kind of how these work. Now these will be, one second here. Now these examples are trades that I've done or that we've done at Power Cycle Trading in our trading room, and also have alert services. Some of these are, these are all trades that we've done. So here's an example of some butterflies. Now the next thing though also is you can adjust your risk and profit of the butterfly from the wingspan of the butterfly. So what that means is, let's say you're a collector of butterflies, right? And the easiest way to collect a butterfly, capture it, would be with a really wide net versus a narrow, small net. So the same concept with the butterfly. If we want to get a bigger profit zone, we just widen out the wings. Now it's going to cost us or put up a little bit more risk of capital, but we've got a bigger profit zone. Now, if we want to really narrow it, we can make a narrow wing butterfly, super low risk, but super high return. So these are sometimes what I refer to as lotto trades. So that's how we're going to adjust risk and profit, is the wingspan of the butterfly. So here's a first example. We're going to look at a directional short that we did. This was about a week back. We did this on Disney. We were looking for a downside move, not a huge move, but move to the downside. So we wanted to do this very super low risk. And so what we did was the Disney short using a put butterfly with a spread width of $3 or $300 per spread. Now we can even do, we can do, like I showed you earlier, we could do a $100 wide spread if we wanted. But here was the butterfly that we set up. This was on the 30th of September, and Disney was trading right here at $113. So it's trading right here at 113. Now, no, excuse me, right here, right there. So what we're looking at, there was good support down here. So, I always look at targets to trade to. So the target that we came up with was 109. There was a gap area. You see that gap in there? So there's a gap area here, and there was a lot of option activity at that 109 strike. So what we did was, it's just a butterfly just targeting down just to 109, and we did this super cheap. And let me show you, go through the steps of this trade. So what we did, we went out on the 30th and we bought for expiration to 9 September, September 2nd expiration. We bought, again, targeting 109. So we bought the 112 put, sold the 109, that's our target, and then sold the 109 again, bought the 106, so $3 wide spread, right? So this gave us a butterfly where our spread width is $300. Now the cost of this trade was only 54 cents. That's the total debit cost or total risk. So $54 per spread. So if you did one spread, 54. If you did 10, that's 540. That's your max risk. Now the potential profit is your spread width of 300 less your cost of that trade at 54. So potential profit is theoretically, I call it theoretical because you'll never get it exactly trying to hit that body, but you get pretty close at times. But that would be a $246 per spread profit or $455 return on your capital, which is you're risking in this situation $1 to make $4.55. Now look at the difference here between if you just went short Disney, the shares, and you hit the target of 109. So let's say you had Disney, you went short at 113, and it went down and hit your target 109. So you covered and closed it out. So you would have made $4 a share or 3.5% return on your capital. In this example, you've got a potential to make 455% return. Now we took the trade off 4 days later, and we were up $48 per spread on our risk of 54. So that's still a nice return over 4 days, 89%. Now going into the trade though, we have potential. When we looked at the trade, we thought, okay, wow, we could make somewhere close to 240, but even if we didn't, we have a great return on our capital at risk, which was only $54. So here's the trade setup. You can see the butterfly. This is the spread width here. And you can see that it went out right here. We closed out the trade. It was trading at 110.95. So on the second, it was trading at 110.95. So this was up $48 per spread, 89% return, versus if you did the shares and you shorted when they were 113 and you hit your target here at 110.95, you'd be up 1.8%. So here's where we closed it out, but that was up at 48, 89% return. So the other thing, I call these low stress. So if you put this on and you think, okay, well, I'm only risking 54. I don't have to be just glued to the screen all day worried about it. So you can just come back, a day later and see what it's doing. Now you can see that the potential here, the great thing, the advantages are, one thing, if you have a small account, these are fantastic trading for small accounts, right? So you could have bought 10 contracts, cost you $540 of risk, with potential to make over 2,000, or you can buy one or two. So that's the beauty there. Small accounts are perfect. Takes advantage of that time decay, volatility, collapse, low risk, high reward trade. So it just has so many different great benefits versus just going outright long or short options or short shares or futures. Now, the next one we'll look at is when we widen that wing out. So this is the wide wing butterfly. So it's going to provide you a much wider profit zone for your trade. So you don't have to nail it perfectly. Structured again for defined low risk, great for hedging. Use what I call targeted directional swing trades. These are basically what we use for swing trades that moves that might take a day or 2 weeks. So perfect for kind of swing trading cycles. Also great for what we call pinning trades, or when we look at directional pinning trades. So if there's a certain strike price that you think maybe at expiration, may settle at that strike price, we call that pinning. So we can play pinning trades using the butterfly for very low risk but high, kind of reward type trades on that. Great when we're in high volatility markets, because as implied volatility goes up, we get more premium. So that's a big benefit. Another great advantage is not only so for small accounts, you can trade, small accounts, but if you have a really high price stock and you want to trade that, this is an easy way to trade with lower capital that you're putting out to trade the stock. And I'll go through an example to show you here in a few minutes. Now, the trade durations typically will look for one short, maybe even a day trade, or out to 2 weeks. It's kind of typically about as far out as I like to go, because we really gain the advantage from the duration of that theta decay. So these will always give you a positive theta, so you're not going to lose time decay daily. You're going to actually be gaining from that. So no time decay, and these will give you returns of 2 to 1, 10 to 1, or sometimes even higher than that. So those are some of the great benefits just from a wider wing butterfly. So here's one that we did. This is another one we did with my alert service, going out to members of the alert. So we did a short trade on QQQ, and we did this short trade using a wide wing put butterfly. So the spread width is the butterfly that we did here was $10 or $1,000 per spread. So let's walk through it. Now, so the alert, this is kind of what it looks like when these alerts are sent out. So we did this was on the 23rd of August, and QQQ was traded at 314.60. So this alert was sent out to the members of the alert service. It says new QQQ short trading at 314.60. This is what I call cycle high retracement reversal on the daily time frame. So this alert says, okay, buy a butterfly on QQQ, and the option expiration series, the 26th August, by the 314, 304, 294 at around 210. So then I put a summary so it's real clear to you. So this UV long the 26 August 314 put, short 2 of the 304 puts, and then long the 294. So that was the alert sent out. So here's what the trade actually looked like and ended up doing. So on the 23rd, this is all based on my trading system, and kind of based on targets that we're looking at. So it was trading right here on the 23rd. It's trading at 314.60. So we were looking for a target down here to about 305, 304 in that range. But if it didn't hit there perfectly, we still have we did this as a wide body butterfly, so we have a big, huge wide profit zone. So look at momentum. I like to use momentum to give me directional down or up, and the direction was down. So it was a good setup, just looking at the charts and our indicators. So we did this though to keep it low risk but super high reward. We did this with the put butterfly. So went out, and this was again on the 23rd. You can go back and check it out if you like. We sold on the 23rd. QQQ was trading at 314.60. So went out to that 26th August expiration series, and our target, we were targeting 304. Now, if you had just shorted the ETF shares at 314.60 and you got your target at 304, you were up $10.60 a share, or 3.36%. But what we did was we bought the 314 put, sold that 304 put, bought the 294. So that was our butterfly spread there. Now the total cost, $10 wide, 14 minus 4, $10 or $1,000. The cost of this trade was $2.10 debit, so $210 per butterfly spread. So your spread width 1,000 minus 210. Theoretically, if it hit it perfect at your body at expiration, this trade would make you $790 per spread, that would be a 376% return, or risking $1 to make $3.76. So just no comparison. So you can see your max profit 790, max risk 210. So that was the trade setup. Now let's take a look at how it actually performed. So here it was on the 26th, and at that point it was trading, this day of expiration, it was trading at 306.17. So it didn't hit our target perfect at 304, but it's close enough. So at that point, at 306, when it's trading at 306, this was up $572 per spread. So if you did one, you're up $572. You did 10, you're up over 5,000. Now that's a return on your risk of 272% return, versus if you did the shares and you hit your target of 306.17, you're up 3.6%. So just no comparison. So again, get a big advantage from time decay, volatility collapse, very low defined risk, and great high return, potential returns on that capital at risk. So you can see that when you are in uncertain times, keeping that risk low but having potential for big rewards is a super great combination. Now here's another one I want to show you. This is really illustrates how you can let time decay and volatility, the two option pricing components, work for you with the butterfly. So basically, when you're doing a butterfly or a long condor, there are two components to the trade. You've got the debit cost side, and then you've got the kind of credit spread side that forms the trade. So it's the credit side that gives you your selling time and volatility doing that. So this is going to show you the big advantage of this and how time decay and volatility can really increase your profits quickly on the spread. So here's Amazon. And the other thing too, when Amazon was back, trading where you had it for 100 shares in this example, this was back when it was trading at 178,782. So if you were to do Amazon here and you were buying 100 shares or selling 100 shares, you're going to put out your capital at risk would be $178,200. But we can do the same type of trade, controlling this kind of trade with much less risk with the butterfly. So in this example, we were looking for, just to move up here to this 1830 area. So it was trading down here, and you can see it consolidated, and it just been churning here. So we were finally getting the move up. So we said, okay, let's just trade a short-term target trade to 1830, but we want to do it cheap. We're not going to go out and buy 100 shares. That costs us $178,200. How else can we do it? Well, we could do it with a butterfly. So look at the difference between this and if you did the shares. So in this example, you've got, again, this was on the 29th, it was trading at 1,782. So that if you did the 100 shares, that's a $178,200 of risk that you're putting out there to have this trade work. So instead of doing that, we're targeting 1830. Now, if you did get it right, and you bought those shares at 178.20 or right there, and it went up to your 1830, well, you made $48 a share. But look at your return on risk, only $2.69%, but a lot of risk. Versus what we did was a call butterfly. So we were targeting the 1830. So we bought the 1820, sold the 1830, sold the 1830, bought the 1840. So $10 wide spread, right? So that's $1,000. Look at the cost of the trade, 80 cents. This debit cost, 80 bucks. So the potential for $920 per spread profit if it hits your body, that butterfly at expiration. So that's over 1,000% return. So you can see that these are, realistic, potentially type returns you can get. So risking $1 to make $11.50 versus a return of maybe 2.69%. So there's no comparison as far as risk reward and the potentials that you can get from this. Now here's a really interesting, cool thing about it. So here it is on expiration on the 6th, okay? And this is in the morning AM. So this is like, say, 10 o'clock in the morning. At that point in time, this butterfly was right here, was trading right there. So it was up, it went from 80 cents, $80 to 230. So this trade was, at that point in time, was up $150 per spread, or 187% return. Okay, so still really, that's, I'd be happy all day long with those kind of returns. But here's the interesting thing here. See all that area in here, that black area? That's what's still potential profit. That's made up of the time component and the volatility component that's in the spread. So there's a lot of potential profit still there just for one day. So here it is in the afternoon. And in the afternoon, let's take a look. In the afternoon, going to, this was about 2 o'clock. It was trading right here. It was up a little bit, but look at the difference between the profit on this trade at that point in time. So it went from this later in the day, you know, your cost was $80. Now it was trading at $695 or $695. So you had a profit here of $614 per spread, or 769% return versus that 2.69. So that's the same day. So you got 4 times more out of your profit and return on capital a few hours later because of that time decay getting sucked out in volatility. And those 2 pricing components will go to 0 at expiration. So that's what makes it so dynamic. So you can see the theta here. Here's what you have left of it that you can still take out, $33. Let me back up and I'll show you here that theta on the, you know, earlier. So your theta here earlier was 80. So you had a huge amount of potential profit in there, $80. And then that got sucked out towards the end of the day. So that's the beauty there. So just so dynamic, and ways to use it are just, you know, really great. Now the next one I'll show you is the long condor. So very similar to the butterfly, but gives us a wider profit zone. So this is a great one to leg into, leg out of, or just set it up as the condor for super low risk. So here's the spread. It gives you a wider profit zone, structured again like the butterfly, very defined low risk, great for hedging, great for directional swing trades, a wider profit zone, great for high volatility markets because we're selling time and volatility in the spread. We get that, take advantage of that. Trade duration on these can be 1 to 3 weeks out. Again, positive theta, no time decay. Returns 2 to 1 to up to 4 to 1 kind of returns. So this was another alert trade setup. This was on Villatoro. We did this on back on the 17th of August, and it was trading at 116.94. And we were looking for an upside move. So not to go through the, you know, the alert, you know, text here, but we'll just kind of walk through it. But we were looking for an upside move, but we want to keep the trade super low risk. So we did this. We started out with a call debit spread, and then we added the credit spread side to it to adjust it to the long call condor. So here was where we started the trade. It was trading right here on the 17th. It was trading at 116.94 right there. Okay, so we had a nice move up. Momentum was telling us up, so we took the shot to the upside. So we had a multiple different profit target points that we took profit there, and then at the end expiration had profit there, max profit. So on the 26th, then it was trading at 120.175. So you see a pretty nice gain on that. So here's the risk reward on the trade. Let's go kind of walk through it, and I'll show you why it's such a great one for, you know, any kind of market environment, especially when it's uncertainty. So here was the trade setup. You can see max risk on this trade was $107. So went out, we bought the 117, 121 call debit spread. It had sold the 126, 130. So we had this, you know, looks like that condor. Now the max risk on the structure was $107. Potential max return 293. So that was just you know, on this condor. So you can see your max profit 293. That'd be a 274% return. So let's walk through it, and I'll show you how this thing performed. So the trade setup was again on the 17th, and we had the, if I can get my drawing tool, long the 117 call here. 117 call short the 121, then we shorted the 26 August, same expiration, 126, 130. So $4 wide spread between. And here's the structure. So it went from, this was the spread entry with $1.07 right here. Nice theta, look at that, $67 per theta per day. Now on the 25th, it was trading right here the day before expiration, 122.94. So this spread was up to $333. So it went from 107 to 333. That's a $226 per spread profit or 211% return. But the next day, this thing went out max profit because it closed between the two spreads. Okay, so we got the maximum profit out of this. So that's the thing. You can sit back, take a little bit off and then hold for the balance, trying to, what I call hit the home run. So it gives you that kind of flexibility and luxury on your trades. So here it was the next day at expiration, and it nailed it perfectly because it went out between the two short strikes of the spread between there. So the credit spread expired worthless. You kept the full credit on that. And then the debit spread was max profit. So this ended up going from 107 out to 400 on the exit. So this was up 293 or 274% return. So that's the combination there. And then what we'll do a lot of times too, we can hedge and do different variations of things, where sometimes we can get into a trade where we can do it for no risk. So what that basically means is that, okay, let's say we did a call debit spread or a put debit spread, and our cost of the spread was maybe, when we did it, was maybe, let's say $150 was our debit cost originally. Now what I'll do sometimes is we can adjust. Let's say we did a put debit spread and we cost 150 bucks. Now the market goes down and you do an out of the money credit spread against it, and maybe you can bring in maybe $170 credit, sometimes, more than your debit costs. So here you would be then have a credit of 20 bucks. So you could have a trade where you have zero risk. You actually have a credit. So without getting confused, these are the things that you can do. It's just a really dynamic structure once you understand how it works. Now, if you'd like to learn more about these high reward, low risk strategies, again, that can work in any environment, but especially with these extreme market volatility type markets, here's what you can do now. So this weekend, this Saturday, the 10th of September, I'm going to be doing a, one second here. I'm going to be doing a workshop on just the butterflies and long condors for option profits and hedging masters course. So if you'd like to join us, this is a live workshop that you'll be able to ask questions as we go, but also it'll all be recorded. So it'll be yours forever. Once you go through the course, it's yours and you can go back to it over and over. So with this course, I've got a great package for you today. So use this link that I just put in. Let me make sure it works and make sure, yeah, it looks good. It works fine. So that link is what you use. It's a payment link there that you can use. And here's what you're going to get. Not only will you get the course, the 5-hour course, but you're going to also get some great bonuses with it. So the course will start this Saturday, the 10th, 11 a.m. to 2 p.m. Eastern. We'll start there. And then we'll finish up Monday at 5 p.m. to 7. And then we'll do a Q&A the next day. So you're going to have a lot of support for the course. So with the bonuses that you'll get, you're going to get the live course, okay, but it's all being recorded. So if you miss part of it or you want to go back and review it, you can. So you can get the 5-hour live course, just strictly the butterfly long condor. You're going to get another bonus here, my Fibonacci price target mapping course, which is a great course. So these are the price on my website, $397. So this is how we set up our targets. So this is a course that takes you through that. So you'll get that as a bonus. Then you're going to get as another bonus, start trading options today. So if you're even just starting out with options, it's a great package. And so that goes for $197 on my site. And then you're going to get 30-day trial membership to the Power Cycle Trading Club. And that's a $97 a month if you stay in and renew, or you can do annually, but that's what it is monthly. Then we'll do a follow-up Q&A the next day, $300 value there. And then I'm going to give you my option trading tutorial and another nice, what I call my option strategy manifesto. This is 15 other option strategies. So all this, for the price here today of $197. And again, this is a live course plus recorded. So you get the best of both. You can come into the course, ask questions as we go. Now we'll cover just kind of an outline of the course. We're going to go, I always like to start out with the Greeks, what the Greeks are, the vital aspects of those for the butterfly long condor. And then very important that you understand more how does theta and volatility impact the butterfly condor. Now, what are the best option timeframes? I'll show you the kind of the formula, rule of thumb, and the formula that I use for, how far out in time do you go. So we'll address that quite in detail in the course. And then how do you get, trade setups where you get those returns of 10 to 1 or higher with literally as little as $10 per spread. So we'll go through and show you the examples there and how that works. And then we'll go through in the course, you're going to get my Fibonacci price target mapping course as a bonus, but in the course on all the setups, I use the price target mapping. So you'll see how that works along with standard deviation for selecting the targets. Now, another really cool part of the course is we go through what we call pinning. Okay, so every month we've got option expiration. Actually, next week is a monthly expiration. So 12 times a year, we'll have the potential to find, strikes. Maybe we think it's going to go out. Apple might be, have a lot of activity at certain strikes, maybe the 160 or the 150, and we can target those strikes, and that's what we call pinning trades. And we can use the target. We can target these areas where we think it could go out at expiration using butterfly to keep the risk super low. If we're wrong, we lose very little, but if we're right, you have what I call lotto trade. Now, the next part of the course, part 2, though, we'll go through each of the variations with examples. So we're going to go through how, why, and when would you use the long call or put butterfly, wide wing butterfly, broken wing butterfly, ratio butterfly, broken wing ratio, iron butterfly, vacation, long condor. So if you ever saw the movie Forrest Gump, it's like the shrimp, every type of shrimp you could possibly imagine variation. So the course, though, will take you through all these variations with examples of how they're, when, why, and how to use them. So you get a really clear understanding, and then you select the one that you like. Maybe you like wide wing butterflies, or maybe you prefer a ratio. So anyway, you'll have all that information. Now, the next thing we'll go through in great detail will be the long condor, how, why, and when to use the long condor. So another great example of, getting high returns on low capital at risk. And then hedging. Okay, so another big part is just part 3, and this is where the course alone is just hedging. So how can you hedge a core position, or how can you hedge that credit spread? I'll teach you in this course how to hedge credit spreads using a butterfly defense. We've got a step-by-step checklist in the course, how, when to, put on the butterfly, take it off, execution, adjustments, resources. I give you assignment risk, expiration risk, all that good stuff in a 58-page trading library. So a little feedback said, Larry, you are one of the that I know provides competent, realistic instruction on how to have that Houdini escape hatch plan to utilize when various types of option trades go against you. It allows traders to calmly use their head to make appropriate trade adjustments instead of widely panicking. So that's why it's great, because we can keep our risk low, we can do different adjustments, and without getting freaked out and having your head handed to it. So it was a really good comment, I thought, from Richard. So here's the link again. Let's go through I've got a little time to go through the bonuses, I think. And bonus 1, you're going to get my Fibonacci price target mapping course. Just did this back in February. So this is a 3-hour course, 139-page course manual of using Fibonacci, moving averages, price action support, standard deviation, option activity to target and put together price targets for profit or defense. Then you'll get my Start Trading Options Today course. This is a kind of intermediate option beginners course. A great one to introduce you to options if you're not as up to speed as you want. And this is for your option library. So it's a comprehensive, easy to understand trading course on just the benefits of options, mastering puts, calls, and a couple of really great option strategies are covered in the course as well. Then you'll get my 1-month trial membership to my trading club. So you can start this anytime. You don't have to start it right away. It's 30 days. So I've got a virtual trading room open every day in the morning, 9:30 to 10:30. I do video updates, weekly Q&As. You get 60% discounts and an educational vault there. And then 4, you're going to get my support Q&A, which we'll do the next day on Tuesday. And then you also get that 30-day trial membership if you want to renew. Hopefully you will, for more questions. Then you'll get my option trading tutorial. This is another just option course on the Greeks, the 60-page option guide with videos, Greeks, option pricing, standard deviation, and then last but not least, 15 option strategy guides. So this is cool because, you know, how to use a back ratio spread, you know, 15 different other option strategies, or long straddle, strangle. So a really great combination of everything you'll get here. So again, just I hope you'll join and come join us, and it'll be starting this Saturday. And if you can't make it, it's all recorded, so you get the best of both. Now, if you want the alert service, go ahead and, you know, it's just too much right now, but if you want that, go ahead and sign up here today for $197. And if you want to shift it and adjust it to the alert package, you can. So just let me know. So go ahead and sign up today for $197. If you want the alerts, then we can go through all that with you. Okay. So any other questions? I think I'm about up on time, but I might have a little bit more. If I do, I'd be happy to answer any more questions that you have. Yeah, again, if you do want the alert package with this, go ahead and sign up for $197. And then if you do want to add the alerts, I can send you that. Just email us and you just pay the difference. So my email address would be support. Hold on, let me get that for you. At powercycletrading.com. So any questions on the alert package after you sign up, just go there. And I'm really looking forward to working with all of you. Hopefully you'll be there Saturday and for future courses that I do. So I'm pretty much just focused on options. So I've got a lot of stuff that I, you know, put out and send out to my members. Is it butterfly or iron butterfly better for pinning? The butterfly. Iron butterfly is good too. I usually go with the butterfly first. It can vary though. It depends on where it's trading, the strikes and everything. They're both good.
Hi, everybody. Thank you all for being here today. I don't know if it's a good morning, good afternoon, good evening for you guys. So let me know in the chat room, where are you guys coming in from? What part of the world are you here from? Because I would love to know. Let me know right here. You guys could just go to the question box and put it in. Where are you from? So the more interactive you guys are, the more fun you're going to actually get out of this presentation. So where are you from? So Kirti is from Michigan. Awesome. So whom else? Because I'm seeing a ton of people in the room, but only Kirti is responding. If you guys are here for the presentation, be here, right? Like be fully present. So let's go. Where are you guys from? San Diego, Reno, awesome. Where else? Ohio, great. I love it. I love that you guys are all here because first of all, it shows that you are definitely interested in learning more and growing. But also, I always say day trading, especially day trading, it is not a spectator's sport, right? You got to be in it to win it, right? Like you got to get out there, you got to get on that court. And the best way to do that is interactivity, working those charts. If you're going to just sit, you know, in the bleachers and say you want to learn how to play basketball and only watch how the others are doing it, you're not really going to be able to do it, right? So awesome. We have tons of people here. Donald from Ohio, Nice, I think that's how I pronounce it, right? Or Ron. Ron is probably your name, right? Scottsdale. Johannes from Germany. Tara from Maryland. And Sam is from Edmonton, Canada. Awesome. Where else are you guys coming in from? I would love to know. So put it all in the chat box. And also, even though I am here to present to you my presentation, I am here because I know that you guys have questions, that you probably have challenges that you also want to overcome. So this is your chance to ask all those questions. I love questions. I answer all of them. Okay, so don't be shy, hop in and just ask those questions because otherwise, you know, time is our most precious commodity. Never money. Money is not a precious commodity. And it's really important to understand that because we could always make more money, but time we can never get back, right? So you guys are here right now giving me your time. So give it to me, as in be here, ask questions, tackle those things, right? Because you're already taking this time out of your day anyway. You're never going to get it back. So you might as well totally use it for everything you can. And that's what I'm here for. And although my presentation is going to be focusing on 4 basic strategies, I always tell my sons, because right now part of our deal with my son is he has to read a book a month, right? I mean, some of these books are like 700 pages. And he's like, oh, it's just too much information. None of this. I'm like, if you just get one thing that you could apply to your life from that book, that could be the life-changing one thing. So it's the same thing here. That one thing that you guys get from my presentation, I can guarantee will be the one to totally take you to the next level. So let's begin. We're going to be talking about understanding market language to spot high probability trades with analysis. And this is me, Marina, the trader chick. I'm actually coming to you guys from Guatemala. I am an expat. I live in Antigua, Guatemala, and these are my 2 sons. And this is how we get around. I love my scooter. This is the best way to get around. Before I became a day trader, I was actually a fitness instructor and a travel writer. And the main reason I tell you this is because a lot of people believe that you have to have a math background, a financial background. None of those things are true. I came from a fitness instructor background, and I'm still a travel writer because for me and my family, travel is not a luxury, it's a necessity. I'm also trilingual. And the main reason why I bring this up, not because like, oh, how cool, it's because after struggling for years in trading, when I decided to look at the market as a new language, because I learned, so I was born, I was a Soviet Union refugee. Russian was my first language. I moved to the United States when I was tiny. English was my second language. I didn't really even learn English. It kind of just happened because when you're really small, you're still learning language overall. So for me, the transition from Russian to English was just that. It was just learning, continuing my learning process. But when you're in your late 20s and so on, it's a completely different process. And I learned Spanish when I was in my mid 20s. And it was a whole process, right? It's a whole process. If any of you have learned a second or a third language later on in your life, you know that there is a process. And that's when I decided to put that process, that commitment, that discipline into understanding what the market was telling me rather than constantly trying to beat the market or predict the market or other things that really will never work. And that changed everything for me. And I want to show how to apply learning it as a new language because I can guarantee it will completely change everything for you. I've had so many people come up to me after presentations. They're like, oh my goodness, I never thought of it as a new language. And then they wrote me back several weeks later. They're like, this changed everything for me. I'm looking at it as a language and I'm able to speak with it. And the coolest thing about day trading, guys, you could do it from anywhere. So when I was struggling, I was too busy keeping up with the Joneses, right? Because everybody's showing that you need tons of monitors, tons of indicators. It was killing me. I was in constant analysis paralysis, constantly in stress mode and failing until I finally lost a like totally broken account, decided to quit and get away because I was just so stressed, but I couldn't stay away. And I realized that I never really learned the basics, right? I never learned how to say hola because I was constantly thrown into a room of full Spanish speakers and never understood a word. And so I came back. I had 3 monitors. I donated 2 to the garbage men. I call it donation because they were practically new. I just put it out and said, they're yours. I removed all of my indicators and went back to 2. And today I travel the world all the time. Like me and my family are constantly going places. Like in 2 weeks, I'm going to Costa Rica and Nicaragua for 2 weeks. We just came back from Spain, Mexico. I just travel with my one computer, my one chart, and it is golden. And when I said that people used to come up to me after some presentations before COVID, I was doing quite a lot of live presentations, especially with the Money Show and Traders Expo. But now I love being virtual because then I can reach so many more people. So before I get into everything, and I know Anna sends the replays, I have a worksheet that goes along with this presentation, totally free. Go to makingofadaytrader.com, makingofadaytrader.com. Go there, get your worksheet totally free, and you can go along with it now, and also you'll have access to the replay so that you can go at it at your own pace. It's awesome. Makingofadaytrader.com. Go there right now. So I want to talk about the basics of day trading. Look, the majority of us here who drive forget one very important thing. Driving is a strategy. When you first sat down into your car, you probably had absolutely no idea where was the gear, the gear shift, how to put it into first gear, how to press on the clutch, how to press on the brake. All of this is something that you learn, right? Today we hop in, boom, we put it into first, release the clutch and head out, right? But you don't at first. How about the fact that when we get to a stoplight, a red stoplight, now you're like, of course you stop, but it's a strategy. We know that we are not supposed to move. This was taught to us. This is exactly what goes on with the market. There are many things that are basic and important to understand, but a lot of people don't even get it. Like they don't even understand, right? And it amazes me because you need to have a platform to trade, right? And the majority of people, they just go shooting, like just shooting off, and they have no idea how to even use their platform. A lot of times they're putting in shorts when they want to go long and losing money. You need to understand, you cannot just get into a car and start pressing on different things. You need to turn it on. You need to release the brake. These are important things, and we forget the basics. And that's what I want to focus on, right? So you cannot be a Formula One driver in a minivan, guys, right? You cannot do it. You cannot be a trader, somebody that really wants to be a pro at it, scrolling on Robinhood or doing, some rinky dink stuff. You need an actual platform. And the platforms, they give you those free universal indicators that you do not need to spend more money on, but you do need to get a good platform and you need to get real time feed. Again, like I mentioned earlier, everything I'm going to be going over in the presentation, it's here, okay, in this worksheet. Go to makingofadaytrader.com, makingofadaytrader.com, and let's begin talking about market movements and the trends. Look, we all know that there are three trends. We get it, right? We know that there's an upward trend, a downward trend, but however, I can guarantee that 90%, if not more, of your profits are lost in the sideways trend, the channeling market, the chop, the exhaustion pattern, the consolidation. I don't care what you want to call it. But understanding this and staying out of it will save you 90% of your winnings, no doubt. This is what we're going to be really focusing on, understanding that, because trending markets, they do come to a stop and they can transition, and we need to understand when and how, and that's when we can be on the right side of the market. So what's an upward trend? Super basic, right? Each pivot is higher than the next pivot, right? It's pretty understandable. It's a bull market, market trending up, market is going up. This is when you go in for a long, when you are buying. What does that mean? You enter at a lower price point, exit at a higher price point, and you take the profit. Okay, that is going long. That is when you are buying. What is a downward trend? It's literally the opposite. Each pivot is lower than the other pivot. And traders make as much, if not more money on the downward trend when they're selling and shorting the market as they do a lot of times on the upward trend. This is when you go in for a sell, when you go for a short. What does that mean? It means you are buying, you are selling or entering, to make it super simple, entering at a higher price point, exiting at a lower price point, and you're taking that profit in between. This is so important to understand. You are shorting the market. Okay, you are seeing your technical analysis. It's telling you that the market is going to continue further down. You want to be able to optimize it and monetize it. Bear market, market going down, market trending down. Now, let's hop in and learn what is the trader's worst enemy. This is those consolidation areas, the transition areas, the channeling market, the sideways market, indecision, the chop. This is ugly, right? Nobody is buying here. I mean, nobody's going in here. This is not where you want to put your hard-earned money. Look at this. There's absolutely no direction. So why do we traders lose so much money in those areas? I'll tell you right off the bat. Trading is an emotional activity. It is a mind activity, and we have to be strong in the mind. So what does that even mean? Here's the thing, guys. We humans tell ourselves stories, right? Usually negative stories. Rarely do we look at the positive side. So if you're sitting here asking me, what does she mean by a story? I'm going to give it to you in a way that we all understand. Imagine that you just met somebody that you really like, right? A new friend, a new whatever, potential romantic partner. And you hit it off and they're like, hey, you know what? In a couple of days, I'm having a party. And you're like, oh, cool. They're like, I want to invite you. I'll call you tomorrow. And you're all excited. Tomorrow comes and goes and they don't ever call you. And now you come up with the stories. Did I say something wrong? Maybe they don't like me. Maybe they bumped into somebody else and that person said something bad about me. All these negative stories come to life, right? I don't know why we do it. It's human nature. It's an ugly beast. That's a whole other story. But the point is, we do this to ourselves, right? Until 2 days later, this person calls you. They're like, "Oh my God, I'm so sorry. I dropped my phone in the toilet. I lost all the numbers. I had to go and get it all out." So the story was, there was no story. It was literally, they lost the contact. There was nothing wrong with you. Okay. What are the stories that we as traders tell? Here they are. First of all, there's only two types of traders in the whole world. Out of the millions that are out there, there's only two, right? Except for the ones that are pro traders and that could do analytical, no story reasoning. That's the goal to get there, right? But in the meantime, the rest of us kind of fall into this two categories. One, the trend is your friend type of a trader. What does that mean? It means when you are seeing this action happen, you're lying to yourself and saying, you know what? The market's been going up all day. I'm going to go long. Then you've got the other type of a trader, the contrarian trader. And they're looking at this. You know what? The market's been going up all day. It's got to correct. I'm going for a short. So this is when actually learning the language of the market and talking to it will make all the difference, because the other two were stories. They weren't true, because the market is going to do what the market is going to do. So when you see this happen, you listen to the market. And what is it saying to you? It's telling you, stay out. I don't know what I'm going to do. Sit it out. Stop being so anxious. Stop being so amateur and sit and wait. And that's not a story. That's the reality. That's the analytical good decision. And that's what I want to show you guys. Because when you're able to sit there and see that and stay out of the market and make real money, that's when you'll be like, that was the secret for everything. All right. So here's the thing. You could have strong downward trend, massive consolidation area, and then a transition, but you can't predict it. It's going to tell you what it's going to do. And it does this often. So you just sit and wait, because the magic of a real trader is the sitting and the waiting. It is not getting in every 5 seconds, because that is an amateur move. All right. So you have these areas. Boom. You find those breakouts. Another area. Okay. Boom. Another breakout. That's how you read the market. That's how you learn to stay out of those areas. Now, you have to have them as areas. You can't just be putting in these mental things, because they don't ever work, right? It's literally like putting in a mental seatbelt and pretending in your mind that you're going to save your baby in a car crash with your arm. That's literally what a mental seatbelt is. It's literally the mental stop, and it's also the mental areas, because we do that a lot. We put in these mental support and resistance areas. Support and resistance areas, to me, are the safety gears of trading. Formula One drivers know 25% of the drivers during racing season will have an accident or a fatality. It's pretty grim. 95% of traders lose. 25% in Formula One, yet the Formula One drivers get into, by the time they get into their car, they have their helmets on, they have their fireproof uniforms on, and they put on their seatbelts. They're not stupid. Okay, why is it that we don't put any safety gear when we trade. This is your safety gear. Putting in those areas, because it doesn't matter how strong the market is. If it's an area that is respecting, chances are it's going to hit off of it and not break it through. And you're certainly not that genius or the one that could predict when it's going to break. So you have to work with it. Okay, resistance area. This is it. What is a resistance area? It's the ceiling of the market. It's literally where the market is hitting over and over and over again, and it stops the flow of the upward trend. You don't want to be the one trying to break through that upward trend line through the resistance. You have to draw it in. Every single good platform has free drawing tools. It's just the way it is. Resistance area. What is a support area? It's the floor of the market. It is when you have a good downward trend and boom, it's hitting it 4 or 5 or more times. You draw it in, because when you're going live in the live market, the adrenaline is pumping. You want to look to the left and see why you thought it was a good idea. You don't want to be guessing, because at that point, you're literally flying out of your skydive, right? You're not very rational because your money is on the line, and people forget. But it's pretty much the same adrenaline and testosterone levels when you're skydiving and putting your real money on the line, as even worse when you don't have a parachute. Okay, so support area. Guys, learn these areas. They're so simple, so easy, and it's literally the basic language of the market. It's talking to us. It wants to tell you, stop, chill out, let me figure out where I'm going, and then get in. All right, and that's the channel. You want to have the support and resistance drawn in. Okay, you want to have these areas drawn in so that you are ready, because even if it's a wide channel, it's ugly. Look at this. Oh my God, it looks horrible. I would never touch this market, right? Look how strong that is, and boom, it hits the area. This is important to understand. Now, a lot of times I get people asking me, but how do I spot it when it's first beginning? And that's an amazing question, because understanding when things happen in the beginning can save you the most amount of money, energy, or make you the most amount of money, because you're in that new transition. You're in that breakout trade. So how do we do it? How do we spot these areas? Reversal areas and divergences. I literally call this the trader's map to shift in direction and trend. What are they? Double tops, triple tops, double bottoms, triple bottoms, head and shoulders. This is what a reversal pattern looks like. It first starts off as a double top. Oh, and then if it goes into a triple top, I'm already even more hesitant. Now, are reversal patterns 100% indicative that it's going to reverse? 100% no. But what it is telling me is that there is a massive slowdown in the market and it's losing its strength. Do I want to be putting my money in continuously, even though the market is slowing down? Absolutely not. You need to save your money for when you have that real strong confirmation. And for me, the golden goose is divergence. I personally use my MACDs. To me, I love the MACDs, but I know that a lot of people use RSI as well. Whatever your chosen indicator is, what is divergence? So here you could spot that my price action is going up. It's heading up. My MACDs are heading down, right? So this is divergence. What is it telling me here? It's telling me that even though show me it's going up, it's totally losing its strength. I don't want to be touching a market that has no strength left. Now, when I see a reversal pattern with divergence, that to me is 100% stay out, because it's a very high probability it will either change or become a support or resistance area and channel altogether. I don't want to be in those areas at all. Okay, so when I see reversal patterns, I'm already out. With divergence, nowhere near there. But if you look here, you can see that this is going down. Meanwhile, my divergence is already warning me that, hey, the market is about to slow down. I like to have a lot of security and confirmation. I am an incredibly conservative trader because I've lost too much. I don't need to do that anymore. I like to listen to what the market is telling me all the time. All right, so now we're going to be putting all of this together. Remember, everything that I just went over with you guys is in this document, makingofadaytrader.com. Makingofadaytrader.com. So go and get this right now And this way you could go over it. Now, I want to talk to you guys about breaking out of areas. The breakout, the most highest probable trade there is. However, if you don't have your areas drawn in or drawn, you're not going to ever spot it, right? Because those mental areas, they don't work. What exactly is a breakout trade? Look, layman terms, super easy to understand. You live south, your best friend lives north. You get in your car to go and visit your friend who you've seen a million times. You hop on the highway, all is good, you're energetic, you're ready to go. But all of a sudden, there's this huge construction site and they close the road and there's massive detours. And the construction workers tell you to get off on the detour. I don't know about you guys, but I am stressed. What if they stop with the detour signs? My Google Maps and my Waze isn't showing me the new detour routes. I don't know this neighborhood. What if they never open the road again? What if I'm in total doubt, uncertainty areas? Would I be putting money on the fact that I'm going to get to my friend's house? No, because right now I'm in total uncertainty mode. But all of a sudden, another construction worker says, hey, we fixed the road, hop on back on the highway. And I get on and I am full of confidence and energy. That's the breakout. I'm continuing in that same direction, but I don't want to be anywhere near the indifference zone, the indecision area, that uncertain doubt area. And that's this area right here. That's that consolidation, the channeling. Okay. Guys have to understand to stay out so that you could take those really high probable trades. All right. That's how I do the trades. So now I only have two indicators. I have my MACDs and this dotted black line, that's zero, right? There's no energy, there's zero to it. However, when they pop up and it's a breakout and it pops up, no divergence, I put in my order weightings into my EMA lines because my EMA lines is where I take the trade. And I always go in with a limit order, meaning I tell the market where I want to get in. I don't just go in market because then I show the market that I have no idea what I'm doing. And the market likes to penalize me like that by charging me a slippage amount, which is usually 25%. Okay, so if you're going in for something that's $1, you'll probably get in at $1.25. Okay, so remember that. Amateur does not pay. You tell the market where you want to go in, and then you also tell the market where you want to get out, and that's called a stop loss, because putting in those mental stop losses are as stupid as putting in your kid with a mental seatbelt. Okay, one other bonus setup. I call this the initial instant reaction trade. Why? Because again, I'm using my areas and then I want to see when it actually transitions, when it goes the opposite direction, when it has that massive strength, so I can get in as early as possible. Because the best and most powerful trades with the most amount of energy are in the beginning of a new trend, right? So if you understand when that new trend is happening, that's when you can get in and really profit and monetize it. Okay, and that all comes down to literally just listening to what the charts are telling you and understanding and going with it. And it's really that simple. It's not that difficult. Remember, everything I just went through, makingofadaytrader.com. Now, I want to do a little bit of a live analysis with you guys so that you could understand how I look at the market and what I'm seeing. So I personally trade the E-minis. That's my favorite instrument pretty much, simply because it moves the best, it has the highest volatility, and now that summer is over, the movement is super quick. I absolutely love it, right? So I don't have a time frame. I use a tick chart. So I don't know if any of you guys have ever heard of a tick chart, but what I like about tick charts is that, what is a tick chart? So I use 610 ticks. That means for each candlestick, you can see here ticks remaining, it's telling me how many transactions are happening per candlestick, 610. And if it's moving really quickly, I'm seeing that there's a lot of volatility and a lot of volume, because the volume indicator is notoriously known for being the most lagging indicator, right? So you can't really rely on it too much. But when you have a tick chart, it's literally seeing volume in front of you in the making. And look at this perfect, oops, hang on a second. Look at this perfect double top right here forming right here. And look at the insane divergence, right? Is it going to be going down this way? Chances are yes. If not, it's probably going to be forming a consolidation area. So I want to be fully aware of it. And look what's happening, right? It's starting to head down. This is how I read the market. Oops, what just happened here? Sorry. What's happening? There we go. Okay, here, look at this. Triple bottom right here. And on top of that, with that triple bottom, it's showing me that it's not really going to continue in that way. It's been going up all day. And now we try to go down. First it went down. Okay, cool. That looks good. Oh, wait, double bottom with divergence? Absolutely not. And now a triple bottom with divergence. I know that this is absolutely not going to continue on. How long is it going to channel? Not sure. But then boom, look what happened. It changed direction. And then I could hop back in going long. That's how you understand and read the market. And here you have a beautiful head and shoulders setting up, right? And boom, it gave me a really amazing opportunity to go long, but then it failed, continued down again, did not really work again, and now gave me another smaller head and shoulders, right? Or you could put the shoulder here, and boom, it changed direction, and now it's heading up. And this is when I'm going to be looking for it to head up, because now my MACDs are really showing there's massive strength. It had gone through. This is how I read the market. This isn't, anything. You don't need to buy fancy algorithms, fancy softwares. All you need to do is literally just listen to what it's telling you. And it talks to us all the time. Here's another beautiful example right here, right? We have this massive resistance area. Massive. It's a really big one, right? I mean, hit 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Boom. Finally went down. I am all over this short. And boom, it just continues on going short further and further. Okay, this is how you guys read the market. And look what's happening here, guys. Look at that. Triple top, massive, massive divergence. Chances are this is going to head down, and I want to be on top of that. I want to be sitting there waiting for the actual confirmation to tell me when it does. Because at the moment, I'm just guessing. So I don't do that, but I also am sitting out and waiting until it really, really tells me what it's going to do. All right, so this is just how I watch the market, how I listen to the market, how we work together. And look at this, just forming a stronger resistance area. And look at this, getting closer and closer to the zero until it's about to switch. Okay, so this is just one way that I focus on the market and really listen to it, because it's all about that, right? So here's the thing, guys. We have absolutely everything we need to take action. Everything we need to take action. But how do we know that we're doing it right? How do you know if you're doing it right? Who is there to help you really? Because you know what? There's tons of YouTubers, there's tons of summits, there's books, there's podcasts. Sure, but how do we know we're doing it right? And that's the reality. All of this is great, but the real question you're also probably asking yourself is, how do I get started? And this isn't from beginners only. This is from seasoned traders who have been trading for ages but are still losing money. And they ask me, what can I do to turn this finally around to be profitable consistently? And a lot of times it really just boils down to lacking your understanding of the basics. It's that basic, actually, interestingly enough. Remember what I mentioned about the car. When you first get in the car, you don't really know where everything is, right? You might have an idea, but I remember my son is 18 years old, and when he first started to learn how to drive a car, me or my husband would get in and we're like, okay, buckle in, put your foot on the brake, put your other foot on the clutch, put it into first gear, start to release. He's like, wait, clutch? Gear, what, like he did not understand. And it was understandable because he's never sat in the driver's seat before. He didn't even know where the wipers were or the lights, right? I would never permit my son to go on a highway not knowing any of this, and he wouldn't even want to. But with trading, there is no barrier to entry. You can just throw your money at the market, or what I like to say, donate your money to the market, right? Imagine you've never been in a car. Never, okay? And get in, and the person driving is like, okay, put on your seatbelts, buckle up, because this is going to save your life. And you're all freaking out. You're like, seatbelt, where's the seatbelt? I don't know what that is. It's supposed to save my life. And you don't know how to protect yourself. That is the basics. And that is what we are lacking usually a lot of times when we are looking at the market. And this was my own sad truth. I spent over $20,000 on different tradings. And I was constantly failing because nobody went into the basics. They were in either alerts or chat rooms and, showing me this trade, but I had no idea why they were taking this trade. And every time I asked a pretty basic question, oh, can you explain to me about the reversal pattern or divergence? They would either ignore me or treat me like I'm born with this information. You can't ignore that, right? And that's when I just struggled, and I literally, I ended up losing almost $4,000 in less than 5 minutes. And you know what I did? I ended up quitting. I just couldn't take it anymore. But the reality is, guys, everybody who's sitting in this room right now has probably gone through the same thing. And why are we still back? Because we're bit by that trading bug and it never stops itching. And you know why? Do you know why it never stops itching? Because deep down inside, we know that we can do this. I knew that I could do this. I totally knew. And that's when I decided to come back to my charts. Like I was saying before, I had 3 monitors. I literally donated 2 to the garbage men. I removed all my indicators. I had over 10 indicators. It was obscene, and I get a lot of students, they come to me, they're like, oh, I have all these indicators. I'm like, great. Which one is working for you? Well, I don't know, but this YouTuber says this is a good one. This teacher says this one. I'm like, but which ones work for you? And what we do is we end up stripping the charts and then putting in one indicator at a time to see the one that really aligns with you. And that's what I did. I had 10 indicators, removed them all, and put back in 2. I put in many, and a lot of them just didn't make any sense to me. And I removed them. Like, for instance, the Fibonacci's, I could never understand that. Just couldn't get it. It's not my thing. And that's okay. Bollinger Bands, could not do it. So there are many indicators that you think you should know, but you don't have to. It's not your thing. So get over it and find the one that works for you. And that's literally starting with the basics. And one day, one of my students says to me, he's like, Marina, your teaching style is very similar to Coach John Wooden. I'm like, who's Coach John Wooden? I've never heard of this guy before. So, of course, I Googled him and I found out that he was this legendary basketball coach. I mean, legendary. And his entire philosophy was, when in doubt, get back to the basics. Literally, I mean, this guy won 10 NCAA championships, 88 national championships. I mean, this guy was incredible. He trained superstars. Amazing. But every time they began their season, it didn't matter how many balls they dunked the year before. It makes no difference because if you don't know how to tie your shoelace properly or your sock or even dribble the ball because you're too cocky, guess what's going to happen? You're going to be on the court and you're going to have a sprained ankle and you're going to sit out the entire season. It doesn't matter what you know. You need to go back to the basics to perform at the utmost performance. And today, for you guys only, for the people that only came to this presentation only, because I totally understand how valuable our time is, I have a special offer. It is my introductory course. It is boot camp for day trading course. And you can do it on any apparatus, laptop, desktop, tablet, iPhone, you name it. You could do it anywhere. And the course is a one-time fee, $97. Now, you could go right here, bootcampfordaytrading.com. Actually, go and put it in right now, guys, bootcampfordaytrading.com, so you could start to see everything that is part of this course. Remember, $97 one time. This is not ongoing. Bootcampfordaytrading.com. Now, let's see what today in this world can you get for $97 that will bring you the same return on investment. You want to go golfing with your buddies? I don't even think 97 bucks covers one person today. Okay, so if you want to go and invite other people, you're usually forking out quite a lot of cash. How about inviting your family out to lunch or dinner? I live in Guatemala, and at one point I could go out to dinner with my entire family for less than 50 bucks, including drinks. Today, I could barely get it for $100 without drinks. All right, that's the reality, guys. $97. So let me break it down to you. What do you guys get in it? First of all, simplifying your entire structure, your platform. Okay, I cannot even tell you the amount of people I get that have no idea how to use their platform and are losing money trying to trade and they've never learned it. We go past that. We start with a tutorial. I will help you totally set up your platform so that you can hop in and start with the trading process. Then the curriculum we talk about the dissection of the markets, understanding those sideways markets, reversal patterns, divergences, because they will save you all the time. And understanding defensive zone strategies, the reversal patterns, those telltale signs, how to spot those areas of support, resistance areas. Again, guys, divergences, they will save your life. And let's focus on the power of that breakout trade because they are the highest probability trade out there, and to avoid those fake out breakouts because they are really common. All right. So if we could understand how to draw those areas, understanding where those breakout trades, that alone will be incredible. And you will have unlimited access to the curriculum. All this is valued at $1,600. Okay. And here are some of my students. And I have students from all over the world because that's the beauty of trading. Michelle, I'm just finishing boot camp now. Best money I ever spent. Derek, you are the only mentor that checks the work, and that's absolutely amazing. Adrian, I'm enjoying your bootcamp so much. I'm learning every day. But let me share something really important with you guys. Remember how I said to you, how do you know you're doing it right? How? So what I'm doing is I'm including one entire month, unlimited feedback, accountability, mentorship. It's included in the $97 one-on-one with me. Part of that. This is not an ongoing fee. $97 will cover it all because the mentorship is what really will take you to that next level. And I also have a live chat room that it's me, not some moderators, not some admins, me, that we go over everything that we're learning, plus the feedback live and taking live trades, implementing in the live market. You get 1 free month membership. All of this is valued at $2,600. You guys get it for $97. Go here right now. Bootcamp for daytrading.com. Bootcampfordaytrading.com. Here's what you guys will get. Everything in the course. One-on-one mentorship with me and being in the live trade chat room where we see how we take those trades together. Okay? And here's that real reality. I know for a fact because I know how much I spend on my trades. $97 is not even the cost of one trade. Not even the cost of one trade. So all of this, you will 10x your return on investments. You could take your family out to 100 of these dinners and not even think about it. But here's the thing. Because of the price and because of my mentorship, I could only take 25 students. So this is your chance to do it, guys. Go here, bootcampfordaytrading.com, and you will be brought to this particular order form. And you can see you could even do a payment plan of $259, but one-time $97 fee includes absolutely everything. Bootcampfordaytrading.com. All right, guys, go here. I don't set any alerts, Sam, because alerts, the only people making money from alerts are the ones sending the alerts because by the time you get the alert, it's too late. The trade has passed. And a lot of people don't believe that until you spend a lot of money on alert systems and realize, oh, wait, I missed the boat. So remember that. You want to learn how to drive your own car because the more you're going to be giving money to other people to drive your car, the more they're going to be crashing it for you. And I don't think that's really good, right? You want to learn and know exactly how to do it. And $97, guys, to have this education and work with me one-on-one, it's kind of a no-brainer. Okay, guys, so I hope to see you guys in bootcampfordaytrading.com. I'm very excited to work with you guys and really be able to help you to take it to that next level. And thank you so much for being here and spending this morning or afternoon, or some people here are in Europe, evening with us. And thanks, Anna, again for having me. I really, really appreciate it.
I've made a few presentations on this topic because I'm getting more and more into it. I'm convinced that that if you do this right, and I'm a living example. I'm going through the combine right now, which is for prop trading. I'm going to explain what that is in a second. But having built many trading plans myself over the years, there are certain things that are friendly to something like a combine passing the prop trading, and certain things that aren't. I'm going to go through some of that today. I've named this "Their Money, Your Profit" because when you prop trade, prop trading, of course, is when an entity, either a hedge fund or an organization, give you literally put $100,000 in an account and allow you to trade it, where they will give you 80 to 90% of the profit, and that's pretty interesting. The question is, how do they make money? And I'm going to show you they make plenty of money, but I'm going to show you how you can be on the right side of the prop trading and actually be one of the 10% of traders who are successful. It's really the same number as in general when you trade for yourself. So let's go through the presentation. I'm going to show you exactly what I'm talking about. But first, I just want to make sure that if you have to leave early, I know this, I'm the last presenter of 3. I want you to have a paper that I just wrote. You're the first, actually you're the second. I did a presentation yesterday. You're the second to have access to this. So just write that down, thedisciplinetrader.com/prop-win. I'll show it to you again at the very end. There's no cost to you, but I want you to have this, I think it's 5-page paper wound up coming out that I wrote, and I think you'll get a lot out of it. I'm going to go through some of that stuff today, and actually a little bit more detail in this presentation. So why should you listen to me? Here's our agenda. I also want to make a promise. I want to tell you what that is. I've got 5 secrets. I mentioned 3 when we put together this presentation, but now I've discovered a couple more that are important to passing the combine. For those that don't know, the combine is really a combination of 2 testing phases. Before you get the money to trade, you need to prove that you can trade. And there are 2 tests. Essentially, you've got to make, if you're applying for a $100,000 trading account to trade and get 80 or 90% of the profit, if you're applying for that, you've got to pass a test where in simulation where you make $6,000 before you lose $3,000. Okay, and you have to do that twice. So combined, you've got 2 tests. That's why they call it a combine. So you need to pass the combine. I'm going to show you the rules of the combine and how that works. Then I'm going to show you my working account, where I'm at with my account so far. Actually, at the end of August, I'll show you how I've been trading it, and you can kind of see the path I've been taking. And I want to then inspect some charts and show you how I've been able to accomplish what I've been able to accomplish, and why I believe what I have to offer you may help you to pass the combine. And then I'm going to again give you the URL for the white paper, and I'm going to make you a special offer where you can work with me one-on-one at a very crazy price for 90 days, and we can work together to help you pass the combine. Okay, let's get into the agenda. A little bit more about me. 43 years. I counted the years, and I can't believe it myself, but I can't get out of this business because I love it so much. There is a tipping point where all you're doing is kind of losing and struggling to all you're doing is winning and doing pretty well. So when you pass that point, it's hard to leave the business. So, and I enjoy it so much. I really enjoy helping people get to where they want to go as trading. I've written several books. I've written several books on constructing trading plans, and these are the ones I believe that are still available on Amazon. Payne Weber, I worked for them for a couple of years, although they're a big name and a big firm. Didn't really like it a whole lot. I was a commodity specialist for them, but in the end, it was all about selling, and it was hard to sell and trade at the same time. So before I worked at Payne Weber, I ran a very large option firm, one of the largest in the country, international trading. And then when I left both of those entities, I said, hey, I can do this myself. And I've been doing it myself ever since the the late 80s and early 90s. I had my own Hallett group where I was a commodity trading advisor, cleared my trades through my own firm. And but if you ask me, you're kind of asking me now, I think I know that the most important work that I've done really has been in the mental and emotional part of trading. That's something that most traders, most trading teachers, instructors don't touch because they really don't know much about it. I specialize in that with my wife, who is really the heartbeat of that part of the business. And so I'm very proud of the fact you won't pass the combine unless you're a disciplined trader. I mean, you won't win anyway unless you're a disciplined trader. And that means you got to take the emotions out. And there are several ways to do that. I try to work them into trading plans that I build. Here's the promise. I will lay out the pros and cons of prop trading. By the end of this presentation, you'll have a clear idea of whether prop trading is for you. So if that's fair enough for you, let's get going. And I appreciate that too. Here are the 5 secrets to passing the combines. The first secret, frequent, reliable entry trigger. I put it first because this could be the most important feature that I found that makes it a little bit easier to pass a combine. As I mentioned, I'm into writing trading plans for several decades now, and I've learned to initiate trades with a frequent, reliable entry trigger. And when I say frequent, I mean enough so that you're not sitting around waiting for trades all the time where lack of patience could be a problem for you. A reliable trigger, I'm going to be more specific on a reliable part of the entry trigger, and that reliability is getting off to what I call kind of a jump start, a pop in your direction immediately after applying the trigger. Well, whether it goes further than the initial pop or not is less, you can't put your finger on either it's going to happen or not. And if you've got a good trigger, most of the time it will. The frequent, reliable trigger then is very, very important. If you get off to a good start in a trade, I think if you can recall your own trading, if you get off to a good start, good things happen in the long term. I mean, sometimes it'll reverse on you, but many times, if you can take advantage of that initial start, you can have a trading plan that can work out for you in the long term. I'm going to show you how I do that. The tight risk parameters are very, very important in passing the combine because you're given a particular limit. You can't lose any more than $1,000 or $2,000 a day, depending on how much you're trading, you're testing for. You can test for 50,000, 100,000, 150,000, 250,000. So each one has a somewhere in the neighborhood of a 3% drawdown. If you're in a $100,000 account and you draw down that account to below $97,000, you're out and you've got to start your test over again. So you need very tight parameters. Okay, I'm going to go through some of those rules for you. Scalp runner approach. That's bringing you back to the frequent, reliable trigger. If you have a scalp runner approach, which I've been an advocate of for years, but especially for passing a combine, meaning that when you put on a position, you need to put on at least 2 contracts. I'm going to be talking in the sense of the futures market because most combines are involved in the futures market. So if you put on 2 positions when you first start, you treat the first one as a scalp and you treat the second one as what I call a runner, a day trade, a swing trade. So this way, this solves the dilemma that many traders have about, should I take a profit now that the market is stalling a little bit in my direction, or should I let it run? If you can take a scalp, then scalpers always complain that, boy, I should have left that on. Look at how that thing really ran. If you do both, you don't have that conflict. And if you're, if you're somebody who just swing trades, then when the market goes up, it looks like in your favor, comes back down, you kind of wish you took what God gave you instead of letting it come back, and sometimes you're turning a winner into a loser. This way you have both. I'm going to show you how I do that essentially. And nuances to custom fit the trader. I find that, again, the mental and emotional issues of traders are very important of you, the trader. And unless you can control that, you're not going to get very far. You need to run your trading plan the way it's written. And nuances are something that I won't go into in this particular presentation, but they're optional rules that you can use to fit the kind of person that you are. That's all I'll say about that. And we use that in our trading plan. And you need a clear, preserving exit strategy, meaning that when you get a profit, you need to really defend that as opposed to allowing much the market to come back on you and so on. So there's a number of things that you need to do. I'm going to show you how I do it in charts. I want to show you first a frequent reliable trigger. Here's a frequent reliable trigger we use in Loaded Gunner, which is the process that I've been using to trade the trading plan. It's a simple trading plan we call Loaded Gunner, and it's a process that I've been using to get the results that I've been getting on the prop trading that I'm doing through a firm name called Top Step. I'm sorry, lost it for a second. Okay, here's the trigger. It starts with an indecision. These are candle charts. I'm going to assume you know what a candle chart is. It starts with an indecision candle, which means a candle with a very small body. The Japanese farmers who created candlestick trading, they don't pay much attention to the wicks. And I'm doing that right here by just paying attention to what happened between the open and the close. And in this hesitation candle, there wasn't a decision, couldn't decide in this period of time. I'm going to be talking in the sense of 5 minute bars, okay, 5 minute candles. And this system works whether you're trading 2 minutes, some are trading 1 minute candles, some are trading through tick charts. Doesn't really matter. The formation is the important thing. Okay, we have people trading for the combine and for just their own trading, and using all different kinds of time frames with this process that I'm explaining right now. I like the 5 because it allows me little time between formations of the candle to do other things. I'm running a business at the same time. Okay, so here's the second candle, which I call the extension candle. Okay, so you start with a hesitation candle. If the next candle defines a new trend and it passes through a particular moving average, I'm going to show you charts that it's going to be passing through the 8-bar moving average, 8-bar exponential moving average. We use different ones. Don't start trading based on what I show you here. I'm just showing you the reliability of a candle, of a frequent reliable trigger, which is very important. If you can get off to a good start, then it's about managing from there, and we have a really nice tight exit rules to manage. So again, hesitation followed by a decision on direction, which here is north. Okay, it's a long position, and it crosses through an important moving average. And in this case, let's talk about the 8-bar exponential moving average. So what you're doing here is you're buying 2, I'm going to call it micro mini S&Ps. If you buy 2 micros here, and you put your stop down here below the lower of the 2, you do include the wicks in this, so you're putting your stops down here, buying 2, okay, at the market. What I do is I have my finger on my mouse, and as soon as this closes and the first trade happens in the next bar, I'm pressing buying at the market. Okay, so hesitation, extension through the moving average, buying 2 here, putting your stop down here to sell 2 below, a tick below whichever is lower of the 2 in the formation. Then the next thing that you do is put your limit sell in for one of those two positions. Again, we're trading one of those positions as a scalp and one of those positions as a runner. So where do you put that limit? You measure the body here and you extend that body from the close the same distance. So you're going to be selling your first position here. If the market goes up and it hits you and you take a profit on the scalp, you move the stop on the remaining position to break even. Okay, that's the initial trigger process. That's the trigger process that you use. Okay, is everybody pretty clear on that? Can I go to some charts now? Let's hear somebody from the chat or the question or whatever. Just give me some motivation here and just let me know that you're ready to go. Take a look at some charts. Okay. Here's a standard chart just to show you the principle. This was from a chart a couple of years ago, but I'm using this slide when this was a slide that I used when we first came out with Loaded Gun. But it shows your frequent trigger. Here is a perfect trigger going through the moving average. It's of course southerly and not northerly like I talked about. Okay, and you're selling to here, putting your limit buy-in on one of those positions here, and you're putting your stop up here. Okay, well, you quickly took your scalp, moved your stop on the remainder to break even, and you rode this all the way down. Again, I'm not going to go through the exit strategies, but needless to say, you would have been in this with our rules all the way down to here. Here's another. It's funny about trading. You sit down at your desk, and real time is all the way here. You say, boy, I missed that. But here the market went sideways. It challenged the moving average, and then had a nice candle above the moving average. This was another chance to get in. So. Or add a position if you were already there. Here's a look at this, a reversal here. Here's another place to get in that you would have had your scalp. Okay, this right here, I didn't even mark it. You would have had your scalp down here, and then you would have been stopped out at break even on your second position. Here's another. Whether this is a trigger or not, I mean, it is, but would you take it? You need to measure the risk because your stop is all the way down here. So again, we have percentage risks that you need to shore up on in a combine. So again, buying two here, selling the first one here at the equal distance to this body, and so you'd be moving your stop to break even pretty quickly, and you would have been out of this in this right here at this reversal. Now here are two losing positions. Here's a trigger here. It's late in the day, and I don't know if you trade that late in the day, but if you did, this would be a loser and this would be a loser, but they're very small. You see, the idea is that you're going to have losing trades when it doesn't happen, but when you can, this particular trigger is great at finding the initial moment where a new momentum is about to happen, and you can see that happening here. Okay, let me show you some of the rules of retail trading versus proprietary trading. You trade your own money as a retail trader. It's what you're probably doing now. You're trading your own money. You can trade through any broker of your choice. You can trade what you want. As long as you can meet the margin, you can trade what you want. You're restricted in what you can trade in a prop trading. Okay, total flexibility of doing what you want when you want. You make your own rules, so to speak. If you're trading proprietary money, the capital, as I mentioned, is either from a brokerage firm or a hedge fund. Trades made through a specific account. They had me at Top Step, and a lot of them now are using a Ninja Trader. I've always used TradeStation, so I've had to learn over the last month. I had to learn Ninja Trader. So I had to learn. It's not rocket science, and I don't have a complicated way of trading. I'm not putting a lot of stuff on my charts, so it was kind of easy for me to do, but I'm still learning it. But you've got to trade through where they tell you to trade. They want speculative trading. They don't want you to sit around not taking chances, but they want you to do it in a way that you've proven to know how to do that. And whoops, I spelled limited wrong. Activity is limited by a risk manager. You really need to manage the risk more than ever before. Okay, so let's dig into the prop trading arrangement. I mentioned there are different sizes of prop trading. The Top Step and I'm not recommending Top Step other than it's the one I chose because it's around the longest. It's not the cheapest, so there are others there, but for those that want, I do have a special deal that I can get you with Top Step if for another conversation. Or if you join me, I'll make you a value of that if you need that. In any event, if you're trading a $50,000 account, you're going to be paying $165 a month for the right to take the test. If you're trading a $100,000 account, this is the one. So I'm paying $325 a month for the right to take to test in the combine. This is where they make their money. When you read my report, you'll see it more in depth, but this is where 90% of traders never pass the combine. 90% of traders are never successful when they trade, whether it's retail, whether it's for themselves as a retail trader, or they're trading the company money for the combine, the proprietary money. The vast majority of traders are going to lose. So you need to understand that they know that 90% of the traders who are trading they're raking up as people try it month after month after month. There's no risk to these people. You're trading a sim account, and then once you pass your combine, that's when the Top Step's giving 90% now, and they can do that because they don't need to make money from the trading. They make plenty of money from the 90% that are paying them monthly. So if you're not a disciplined trader, you're going to stretch this out. You're going to wind up, it's okay if you take 2 or 3 months, pay $1,000 over the course of a few months to pass the combine, both sections of the test 1 and test 2, but you don't want to string it out too much longer than that. Okay, so don't worry about them making money. So based on a $50,000 account, here's the two-step process to pass the test. Is step 1, this is the first step. You've got a profit target of $3,000. So you're looking to go from 50,000 to 53,000. You can take up to 5 contracts total. So if you're trading the micros, you can take 5 you can take 5 big contracts if you, well, I don't think you can because you won't have the margin. But you can take you can take 5 you probably can take 5 Japanese yen contracts, whatever, as long as you have the margin of 50,000 of their prop $50,000, then you can trade any 5 positions you want, up to 5. If all of a sudden you, by mistake, you're long 5 micro mini S&Ps, and then you decide that you want to offset that, instead of selling, you buy, that's going to be a problem because you just breached one of the rules if you make that mistake and buy instead of sell. And you try to correct yourself, too late. You have to start from the beginning. And if you exceed the number of contracts in step 2 and you break the rule, you've got to go back and pass step 1. So they try to keep you in that monthly paying loop as long as they can. Okay, so you got to be diligent. Okay, daily loss limit for a $50,000 account is $1,000. Once you can't go below $1,000. Okay, on a daily basis, even intraday. Okay. And the weekly loss limit is $1,000. Trailing maximum drawdown is $2,000. In other words, if you get up to 52,500, you can't go below 50,500. In other words, you can't drop below. You can't have a maximum drawdown of $2,000 from any closing high as you trade. Okay, hopefully you understand that. Again, you can dig into these rules on your own, but I'm giving you the basic rules. The step 2, once you pass this and make your $3,000 without having a drawdown of $2,000 from a closing high, you then start again, which is the same rules, only they have a few more. You can't trade a minute before and a minute after a major report. I mean, why do they do that? Because they want to keep you out of trouble. Okay, they're trying to kind of force discipline on you to some degree. Okay, no trading into holidays. They're very strict about trading holidays, and there's a scaling plan of how you can scale into trades and out of trades. It's a little bit complicated, but it's not hard to understand. Won't go through it here, but essentially you got to make the 3,000 before you lose 2,000. Okay, and the best day, you can't have one big trade that that is responsible for your passing that particular part of the test. Okay, they don't want one lucky trade. They want to see that you can trade over time. So no one trade being responsible for any more than 39.9% of your overall profit. So there's a lot of cheese involved, a lot of traction, a lot of traps, as I mentioned. To blow up your account, you got to start over. Break any of the rules, you've got to start over. So you need defense and protection. So let's get into my working account here. Let me see if I've got it here. I'm going to hang in there 1 second. I'm going to try to find it here. Didn't put that up. Let me go through my pictures. Let me get my glasses on. As you see, I got a lot of pictures here, because I took a picture of my closing. We're getting there. Whoop. Sorry for this. I should have had this for you. There I see prop results here, but that's not what I wanted to show you. Hang on 1 second. Looks like it may have gone somewhere, but let's see what this one here. Oh, here it is. This is you can see this is actually mid-month. You can see where there's 82% winners, and you can see where where my curves is going here. This is my own particular trading in the prop. This red line here you can't go below, and this is the absolute line. Okay, so this is, you can see that my down days are very shallow, and my up days are much greater. My average day is twice $350. My average losing day is $150. So this is the kind of chart that I want to help you to build. I'm now past this. I'm only about $1,000 away from passing this first. Wish I had that chart for you, but I think you can see how successful I've been in doing this. Let's look at some charts, and I want to show you exactly how I've been able to achieve that kind of that result. Here is let's look at today's. You want to look at the S&P? Let's look at S&P. I'm going to move this aside so I won't be able to see the questions, but I want to show you the trigger in action. Here's today's action. I haven't even looked at this, but here is this is a signal right here. Okay, now you would have to measure this. This happened at 7 in the morning because I took this signal. This happened at right after 7 in the morning, and you can see that you have a indecision followed by a strong candle through the golden rod is your 8. I'm going to take this off. This is we have what we call a guardrail. I'm not going to be. This is part of the exit strategy. This keeps you out of false breakouts, and it also allows you to stay in trades. But I'm going to remove it here because I'm just talking about the trigger. Here's another trigger here. But look at this trigger here. Now you got a little scared here, of course, right? But look what happened. Beautiful. Again, you've got your stop up here, and the market turned out really nice until you had. This is some who are trading this may consider this particular one a trigger here, but I consider this a little bit too big of a risk. But those who have taken, maybe they take 2 micro mini contracts here, this turned out pretty nice. Now this looks like a reversal, but our system would have had you in this. This is a bigger signal and so on. Look at what happened here until we got another reversal signal here. Again, we have a small body followed by a movement through the 8 in a extended candle, and boom, look at this. here's what we would be doing. You'd be selling 2 contracts here, let's say 2 contracts of micro contracts here. Then you would put your limit buy-in for one of those contracts at an equal distance of this body, okay? And when you were hit here, you took your profit here, you would move your stop down on the remaining position to break even. So you really wouldn't have been challenged. Looks like it would have almost happened here. Although it looks like right here is where you would have taken your scalp, okay? And then you would have been in for all of this, of which you would have been out right in this area here during this candle. So you can see how, let's look at, I don't want to, make it seem like I'm just jumping and showing you stuff that works. This works all the time, but you got to know when to get out. Here's another signal here that worked out nicely. Another one here that worked out nicely. This is a losing signal, right? But you lost this amount. Look at what you gain. And sometimes here's one where sometimes you take, I would say about 1/3 of the time you take your scalp and you break even on the rest. Okay, so we're having better results on what I'm showing you here. But overall, you would have taken your scalp here. Here's a hesitation, movement through the 8. Take your scalp here, and you would have been out 1, 2, 3. You would have been out right here on the second position, which looked like about the same amount as a scalp. But you would have reversed it here. You would have gotten out of your scalp here. I mean, if you just follow the system, here's another one where you may have 1, 2, 3, 4. This is the end of the day, so you wouldn't have taken that position anyway. I don't like to trade. Funny things happen in the very end. Is there? Let me look at a different market. I'm going to look here at the. Let's look at one I really like to trade, the euro dollar. There's been a lot of activity in euro. Look at this right here. This happened at 12:30 today. Now this doesn't look like much of an extension, okay, but it qualifies. You have 2 days right here, not days, but 2 5-minute periods where you have indecision followed by a movement higher. What I like about this signal is that it's happening. We have a low here that it's testing, another one here. You've got there's a lot of price action in this area, and you've got a very small risk. And look what happened here. Just beautiful, beautiful action. There's another one here. Again, ignore this for now, but you have another one here that resulted in a nice scalp, and you would have been out right here on the second one. So another small. Here's another. So I'm showing, here's a losing one if you were to take this, but followed by a winner here. These are borderline. Generally, I'm not taking these, but this is what I like to see. I like to see a little bit more difference between the 2. I like a very small body and a nice body here. Something like this is a beautiful signal, right? I mean, it only got the scalp, but that's fine. Then you break even on the second position. Okay. I think I really did want to just show you the importance of the scalp and runner approach and how it works with a reliable trigger like that. Let's I want to show you what I got for you, and then I'll take questions. Maybe we'll take a look at a couple of charts if you want to, because I don't want to drag it too far here. I want to give you this quote. I think it's important, says it all. The loaded gun, which is the trading plan I'm showing you here, is simple to understand and set up with easy to follow rules that work in any market, and it works in any time frame. It takes me less than 5 minutes to look at all the markets I trade and to make my plan for the day. First, test the loaded gun and trade it in sim. Build your confidence, and then go live. Examine all the included nuances. Remember, nuances are what how we can kind of tailor with some optional rules who you are. If you're not a patient person, there's certain things you can do to solve that impatience without increasing risk. And then test them to see if they improve your returns. After that, and most importantly, follow the rules and join the small percentage of traders who are consistently making money in the markets. The final point, no system is 100% perfect, so you'll have some losing trades. Keep your risk low. If you're trading correctly, you'll have many more winners than none. This is Ted, who is, we meet all the loaded gun people, we meet every last Wednesday of the month. Ted's at those meetings a lot, and we talk about some of the things we're finding out about the system, some of the things that really been working in certain markets, some of the things we're testing out. That guardrail, that other moving average that I talked about to keep you out of bad trades, and maybe keep you in trades that you would normally be getting out of with the basic rules, that was developed by one of the users. It wasn't developed by me. I'm the guy who wrote the trading plan, but we've got a lot of really smart minds working with it, and we improve it even more all the time. Your processes are usable by every trader for every trading style to guide each of us in creating your own personalized systems. The tools you have developed have helped me increase my profit, win ratio, confidence, and most of all, my job satisfaction. As a full-time trader, it's been the greatest benefit of all. And this is Alan, who does a lot more trading now that real estate is slower. But the job satisfaction, you've got to enjoy what you're doing, okay? And that's what I'm hoping to hand you with working with you one-on-one, to make sure that you understand the program and make sure that you move ahead if you're using it to pass a combine or whether you're trading your own money. Of course, this trading plan works either way. Again, I want you to have my paper. This is free. Just download it. thedisciplinetrader.com/prop-win, okay? /prop-win gives you a little bit more insight on how the background of prop trading, how it's come to be, and a couple of more tips on how to beat the system, so to speak, and not have to pay every month. Once you pass the prop tests, the combine, no more monthly charges. Okay, so once you pass the combine, no more monthly charges. So you gotta get past it. Okay, I want to give you this fourth quarter push special. If you're looking to, if you can pass the combine here in the fourth quarter, you can start next year, even by December 1st. Say each test should maybe take you a month if you just do it very conservatively. And I've been trading very, very conservatively on these charts and the charts that I'm showing you. And I want you to pass the combine. If you're looking to do this, there is a way to do this. I believe I've got that way. I think I've shown you that I've had some initial success. I'd like you to grow with me on this, okay? The loaded gun simple trading plan is normally $14.97. That's what we're selling it for right now. And it includes the core trading plan, which is so simple it fits on one sheet of paper, okay? The nuances that I've mentioned a few times. We have a Facebook group that you can be part of, a private group. And I mentioned the monthly meetings that we have, but more than that, I want to work with you for 90 days one-on-one, and this is why this is a limited kind of offer. I made it yesterday, and on a similar presentation, so I almost had to cut it off here because my calendar only can fit so many people one-on-one, but there's room for some more, and I made a lot more time for this because I'm really into this. I really think that if you can beat this prop trading, it could be a very, very good thing for you. I know it sounds like a dream and it's too good to be true, and a lot of people have different opinions about it, but I'm saying to you that a disciplined trader can really make hay with this. It'd be nice to trade $100,000 of somebody else's money and get 80 or 90%, okay? I want to be there for you as much as you want me to. So I'm giving you unlimited coaching with me right now for 90 days, okay? And I made it a $2,500 value because what I'm seeing is that most people over the 90 days, in the past when I've done this, maybe we talk 4 or 5 times over that period of time. So I'm figuring $500 an hour for my time, which is what I charge. So okay, that's where I put the 2,500. It's a real number. Okay, now the way this would work is that you would look at the videos for the loaded gun simple trading plan. Look at the videos. And the nuance video, so that you can tailor the optional stuff to who you are and make it even more comfortable, as Alan mentioned in his quote, for you. And then then work with charts and have some questions. Meet with me for the first time. Okay, it's only going to take an hour, and that's 2.5, 3 hours to go through all of the videos to train. And then there are recordings of our past meetings, those Wednesday meetings. You're welcome to see as many of those as you want where we talk about the system. But once you think you have it down pretty well, and maybe a few questions, we have our first meeting. then you trade it either in sim, or you may want to start the combine right away. And as you're doing it, you may have a hiccup or something. Ask me what I do. Let's meet again. Let's meet again. Let's meet as many times as you need me. I will meet with you, and we'll go over the trading plan, how it's best used, and how it can be best used by you, because every trader is individual. Okay, so there's a total value here of $39.97. Okay, $14.97, and the $2,500 for the 90 days of coaching. Okay, and a total value of $39.97. Again, we're selling it now for $14.97 at a nice discounted price, but I want to slash that in half for you. Okay, $747 is all it's going to cost you. Okay, that is your total investment. There's no payments here. It's a total investment to own Loaded Gun Simple Trading Plan for life, be part of the Wednesday meetings for life, and have 90 days with me to move through this one. Now you can, if you can adjust those 90, some people are taking vacation next week. Had somebody that just came in and asked me if they could start the 90 days when they get back. Sure, I'm not, I'm not going nuts on counting down. I want you to get this down. Okay, you need to have a coupon code, and that coupon code is their money. Okay, so if you go to simpletradingplans.com, and again, the offer to work with me is going to end soon. It may end with this at the end of this presentation, depending on how many, if 4 or 5 people come in, and that's certainly capable with this crowd. There's a decision I'm going to have to make, and I'm going back and forth. I mean, I love to spend time with traders, but I can't. I've got a life. So right now, I'm offering me. Paul can help you do that too, but I want you to help. I want you to have me in this offer. So simpletradingplans.com. Okay. Use the code their money at simpletradingplans.com. You'll read the full. You'll see a whole lot of testimonials about how well Loaded Gun has been doing for traders for the last couple of few years. Okay, it's the only trading plan that I use. I want to show you how I use it to get that chart through the combine. That chart continued looking exactly like it for another week. Wasn't able to show you that. Don't know where that graphic went, but I think you can believe me on that. In any event, simpletradingplans.com. Use the coupon code their money, and we will get started together. There is, Peter Oren said, I'm not sure if you read this, but I'm now using Loaded Gun exclusively. I thought my problem was psychological, when in fact my system just didn't work. I cannot thank you enough. And when we talk about this, Peter and I, it's really the psychological agents that are built into the trading plan that really was the crux of what make that happen. Here's one other person. For years, I've struggled with consistency in my trading. I'd win a few trades only to get it back, give it all back in the next few trades, or would hesitate to take a trade because I couldn't determine what a good setup was. Thanks to the Loaded Gun system, my trading results have drastically improved. Now I have a clear and simple setup, low risk, high reward, high probability. It's made all the difference in my trading business. He frames it as a business. One of the things that I talked to him in one of those one-on-one meetings, you got to frame it as a business. No longer do I hesitate to take a good setup. And with the monthly meetings and nuances you teach, the system is continually adapting to the changing market conditions, which I think everybody really loves. I'm just not going to hand you. If things change, hey, listen, I'm a trader. A lot of gurus, and I'm going to call myself a guru for the moment. I hate that, but they don't even trade, and that's okay. Teachers are good, but it's nice to know that I think for some people that I do trade. Ronnie Bass is the person that wrote this. He's a terrific guy and a terrific trader, and so he's thankful for me putting it out there for him. Again, the offer is here. Simpletradingplans.com. I really spend 90 days with me, as many times as you want. I say, most people, it winds up to be 2 or 3 times, 4 times. There are some people who meet with me. Was one person meet with me every week, just like to talk. But some of those were short meetings, because if we don't have anything to work on, this is not a social thing. This is a how do we win? How do we pass a combine, or how do we win with our own money? So that is it for you out there. I'm not sure. I know I'm the last speaker. I don't know if we have any questions at all, but right now I'm done, Anna. So unless you see any questions, I am through. I appreciate everybody being here with me. Please do take advantage of this. I love working with traders to really, quell the rumors that nobody can win a trading. You can win a trading. You just have to have the right guidelines and the right person to help you through that guiding. So hopefully I can be that person. Love to have you. Again, it's limited. If you want to work with me, you probably should grab it right now or sometime in the next half hour, hour. All right. Well, thank you very much. Thank you, Anna, for having me. I love being on the same stage as the two people. Marina's the best, isn't she?